Welcome back to the deep dive. It is Sunday, February 1st, 2026. And today we are looking at a story that, frankly, makes all the headline-grabbing AI software drama of the last 2 years look like a bit of a sideshow.
That's a bold claim, but when you look at the returns, it's hard to argue.
It really is, because while everyone was watching the chatbots and the image generators, arguing about which model was smarter, there was a company quietly sitting in the background, a hardware company. And it has delivered a total return of 1,500% in less than a year.
16 times your money in 11 months.
16 times. And we aren't talking about some obscure crypto coin or a startup from a garage last Tuesday. We are talking about Sandisk.
A household name.
Right.
The brand on that little SD card you used to put in your digital camera.
Exactly. And if you had told me a year ago that a memory chip company would be the hottest stock on the planet, I probably would have laughed. So for anyone who hasn't been glued to the news, Sandisk spun off from Western Digital back in February 2025.
So we're looking at almost exactly 1 year of independence.
Right. And in that time, it hasn't just beaten the S&P 500. It has absolutely crushed it. It's the best performing stock in the index.
By a wide margin. And you have to remember the context of that spin-off. When Western Digital cut them loose, it wasn't, a celebration.
No.
A lot of analysts saw it as shedding dead weight. The memory market was soft, prices were low, and Sandisk was seen as this dragging anchor on the parent company.
Which makes this whole turnaround even more insane. So here's our mission for today. We've got a massive stack of financial reports from the quarter that just ended. We have analyst notes from just this past week, late January 2026, that are, they're all over the place.
And a lot of market data. And we need to answer one very specific question: why? Why is a memory chip company suddenly the center of the financial universe?
And maybe more importantly for you, the listener, is it too late? Because when I see a chart go vertical like this, my instinct is bubble. I see GameStop flashing in neon lights.
But the data suggests something else might be happening here. It suggests a fundamental breakage in the global supply chain, a shortage the market just did not see coming.
So let's get into it. Usually when we do these deep dives on AI, we talk about the brains, right? The NVIDIA chips, the processing power.
The models themselves.
But Sandisk, they make storage. Why is storage suddenly the sexy trade?
Because AI needs to live somewhere. And this is the part of the AI stack that people ignored for way too long. Think of it this way. Everyone's obsessed with the AI brain, how fast it thinks. But that brain has to be fed.
Okay, that makes sense.
It consumes massive amounts of data to learn, and it generates massive amounts of data when it gives you an answer. You can have the fastest processor in the world, a Ferrari of a chip, but if you have nowhere to put the fuel, or if you can't get that fuel into the engine fast enough, well, the car doesn't move.
So Sandisk is the fuel tank.
They're the fuel tank, the fuel line, and the warehouse that holds all the fuel. Sandisk makes NAND flash memory. This is the hardware that physically holds the data. And right now, the world is running out of space.
Running out of space sounds like a sci-fi movie tagline. But let's look at the timeline, because the speed of this is what really caught my eye. So Sandisk spins off in Feb 2025.
Correct.
And since then, it's just been a rocket ship. But specifically, looking at data from just last month, January 2026, the stock price has more than doubled in 4 weeks.
In 4 weeks.
As of yesterday, January 30th, it closed at $576 a share.
That kind of price action is a violent repricing. It's the market suddenly waking up and realizing, oh, we did the math wrong.
Well, looking at these analyst notes wrong is a bit of an understatement. Wall Street seems completely confused. I'm looking at this spread and it doesn't even look real.
It is rare to see this much disagreement on a major company.
I mean, look at this. The median target, so the consensus view jumped from $400 to $690, essentially overnight.
Which implies, what, a 20% upside even from these record highs?
But then look at the edges. You have the bulls saying this is going to $1,000 a share. That's another 70+% upside from here. And then you have the bears saying, nope, the party's over, and predicting it drops to $235.
That is a massive gap.
It's a chasm. How does a regular investor make sense of that? How can highly paid experts look at the same data and one sees 235 and the other sees 1,000?
That disagreement, it's characteristic of a paradigm shift. The bears are looking at historical cycles. They're looking at the last 30 years of chip history, and they're saying, what goes up must come down. This is a commodity, prices will crash.
And the bulls?
The bulls are looking at this AI infrastructure build-out and saying, we have never seen demand like this before. The old models don't apply. We're in a supercycle.
A super cycle. Okay, we'll come back to that term because it sounds expensive. But first, let's dig into the mechanics of this shortage. Shortage is a word that gets thrown around a lot. This feels different. Why can't they just make more?
It's not that simple. We are looking at a critical shortage in enterprise-grade memory chips, specifically NAND flash. And that distinction matters.
Explain the enterprise grade part. Why can't they just use the chips from my USB drive?
Reliability and endurance. This is the physics of it. An AI server runs 24/7 at maximum heat. It reads and writes data constantly. And every single time you write data to a flash chip, you degrade it just a little bit. It wears out.
I didn't actually realize digital memory wears out.
It absolutely does. A consumer-grade chip, like what's in a cheap laptop, might burn out in a few weeks under the workload of an AI training cluster. Enterprise chips are built to survive that torture.
And making those is hard.
It's very hard. It takes time. And the yields, the number of good chips you get per wafer are lower. And when supply of the good stuff is low and demand is basically infinite.
Prices skyrocket.
Exactly.
I have the stats here from the journal. Memory prices went up 50% in the last quarter of 2025 alone.
Which is huge for a commodity. Imagine if the price of oil went up 50% in 3 months. The global economy would shudder.
But wait, it gets crazier. They're projected to rise another 40 to 50% by the end of this current quarter, Q1 2026.
Just think about the leverage there.
Yeah.
Sandisk has basically sold every chip they can make for the next 6 months. And they are selling them at double the price they were a year ago.
So if you're Sandisk, you're just sitting pretty, you make the thing everyone needs, there isn't enough of it, and you can charge whatever you want.
To an extent, yes. But here is where this gets really interesting. Because a rising tide lifts all boats, right?
Right.
Usually in a shortage like this, every memory company wins. Samsung wins, SK Hynix wins, Micron wins.
Yeah, if everyone is starving, every restaurant makes money.
Typically. But Sandisk is actually outperforming its competitors. They are stealing market share.
I saw that data point in the report. They're the 5th largest player globally, but they gained 2 full percentage points of market share in the year ending September 2025.
While Samsung and SK Hynix, the giants, actually lost share.
That seems really significant. Usually the big guys squash the smaller players in a crunch because they have more factories. So why is the smaller player eating their lunch?
It comes down to execution and two secret sauces, if you will. The first is their partnership structure. Sandisk has a massive joint venture with Kioxia, a Japanese manufacturer.
Kioxia, that used to be Toshiba Memory, right?
That's the one. And this joint venture is unique. They split everything right down the middle.
How does that help them win?
It's all about capital efficiency. Manufacturing chips is incredibly expensive. We're talking about fabs, fabrication plants that can cost $10 billion to build.
Wow.
And they take 3 years just to come online. By partnering with Kioxia, Sandisk splits those R&D costs and capital expenditures.
So they get access to all that tech for half the price.
Roughly speaking, yeah. They get economies of scale without having to be as big as Samsung on their own. It gives them what they call supply chain security.
Okay, so secret sauce number 1 is a smart marriage. What's number 2?
Vertical integration.
We hear that buzzword a lot, vertical integration. Translate that for us in the context of memory chips.
In plain English, it means they cook the whole meal. They don't just buy the ingredients from someone else and assemble them.
Okay, break that down.
Step 1, they manufacture the memory wafers, the raw silicon. Step 2, they package those wafers into chips. And step 3, this is the crucial part, they build the actual SSDs, the drives, including the controller.
A controller sounds like a little remote.
Think of it as a tiny, specialized brain inside the drive. It tells the data where to go, it manages the traffic, it balances the wear and tear on the chips to make them last longer.
Okay.
So if you just buy chips off the shelf and stick them in a drive, you're limited by the generic specs of those chips. But if you make the chips and you make the controller, you can tune them to dance together perfectly.
So it's like Apple making the iPhone hardware and the iOS software.
It's a great analogy. It allows for optimization of performance and reliability that a generic assembler just can't match. And going back to our earlier point, for enterprise clients, the big cloud companies running AI, reliability is everything.
A failed drive could be a huge problem.
It can cost millions in lost time. And speaking of those big cloud companies, the notes mention that hyperscalers are currently testing Sandisk's enterprise SSDs.
That's the golden ticket, right? The hyperscalers are the Amazons, the Googles, the Microsofts. If they validate Sandisk's drives and switch over, that market share gain we saw.
That's just the appetizer.
So they have the tech, the efficiency, and the market tailwind. Now, let's look at the scoreboard. The earnings report from January 29th.
The catalyst for this latest jump.
The numbers are just mind-boggling. Revenue up 61% to $3 billion. That's great. But the earnings, non-GAAP earnings up 404%.
To $6.20 per share.
404%. Help me understand that math. How does revenue go up 60%, but profit goes up 400%? That doesn't seem to track.
That is the magic of operating leverage.
Yeah.
This is a concept every investor really needs to understand.
Okay, explain it for us.
Imagine you own a factory. It costs you $1 million a month to keep the lights on, pay the staff, run the machines. It doesn't matter if you make 1 chip or 1 million chips. Those are your fixed costs.
Okay, I'm with you.
Let's say last year you sold just enough chips to cover that $1 million. Your profit is 0.
Breaking even?
Right. Now this year, because of the shortage, prices go way up. You sell the same number of chips, but now you bring in $2 million in revenue. Your costs are still just $1 million. Suddenly, you have $1 million in profit.
Ah, so a small increase in sales leads to a massive jump in profit because the bills are already paid.
Precisely. Sandisk's fixed costs stayed relatively stable. But because prices jumped 50%, their revenue exploded. All that extra money flowed straight past the expenses and landed on the bottom line. It's pure profit leverage.
So their costs are flat, but the cash register is ringing double time.
And they don't see it slowing down. Look at the guidance for this current quarter, Q3. They are projecting revenue to jump to $4.6 billion. And earnings, they're expected to be $13 per share.
Wait, they just made $6.20, and they're saying next quarter is $13.
They're projecting earnings to double again in just 3 months.
That is absurd speed. That's software company growth, not hardware. Hardware is supposed to be slow and steady.
It is highly unusual. And it aligns with what the CEO David Goeckeler said on the call. He told analysts, and I'm quoting, "We continue to see customer demand well above supply beyond calendar year 2026.
Beyond 2026. So he's putting a stake in the ground. He's saying this isn't some 3-month blip. This is a multi-year problem.
That is the bullish case right there. If supply can't catch up for 2 years, Sandisk just prints money for 2 years.
Okay, so everything sounds perfect. The stock is up, profits are up, demand is endless. But you and I both know there is always a but.
There's always a but, especially in semiconductors.
This brings us to the risks, because if I'm listening to this, I'm thinking I need to sell my car and buy Sandisk. But the experts and those bear analysts predicting the drop to 235, they're waving a giant red flag.
And that flag says cyclical.
Right. The chip industry is famous for this, the hog cycle, boom and bust. Walk us through how a company making this much money could suddenly just crash.
It is the oldest story in the book. It works like this. Shortage happens, prices go up, everyone makes a ton of money. So what do?
They build more factories.
They build more factories, they run the machines 24/7, they ramp up production to capture those profits. But here's the trap. The customers panic.
The double ordering.
Yes. Imagine you are Apple or Dell. You need 1 million chips, but you know there's a shortage.
Yeah.
So you order 2 million from Sandisk, hoping you get at least half of your order.
Which makes demand look even higher than it actually is.
Exactly. It's phantom demand. Sandisk sees the order book and thinks, wow, we need to build even more. And then
The music stops.
it stops because everyone brings that new supply online at the exact same time. Suddenly, the shortage is over.
Yeah.
The customers realize they actually have too many chips in the warehouse. They stop buying completely to burn through their inventory.
And prices crash.
Prices crash. Profits vanish. Stocks tank. It has happened with memory chips for 40 years. It's a commodity cycle. The bears argue that Sandisk isn't a software company. It's a commodity producer enjoying a temporary price spike.
So the argument about the valuation, right now it's trading at roughly 80 times earnings, which honestly for a tech high flyer isn't totally insane.
Especially if you believe the growth estimates. Wall Street says adjusted earnings will grow 156% annually through 2027. If that happens, paying 80 times earnings today is actually cheap.
If being the operative word.
That is the big if. The risk isn't that Sandisk is a bad company. The risk is that the market anticipates the bust before it even happens. Investors are always trying to front-run the news.
So even if Sandisk is still making money, if Wall Street decides the peak is in.
The multiple crashes. This is what we call multiple compression. Instead of paying 80 times earnings, investors might only be willing to pay 15 times earnings. Even if earnings stay high, the stock price collapses because no one wants to pay a premium anymore.
That's the scary part. It's psychological. You're betting on the mood of the market.
You are. And it is impossible to predict when that sentiment shifts. It could be next month. It could be in 2027. But when the cycle turns, it turns fast. That $235 price target from the bears, that's what happens if the market decides the party is over.
So you're basically playing chicken with the global supply chain.
In a way, yes. You are betting that the demand for AI is so massive, so transformative, that it breaks the historical cycle. You're betting on the super cycle.
Which brings us back to that classic question, is it different this time?
The four most dangerous words in investing.
Truly. But let's recap. We have Sandisk. For you, the listener, the takeaway here is really about understanding the hardware constraints of this AI revolution. We talk so much about the code, but the code needs chips. And right now, there just aren't enough chips.
And that bottleneck is where the money is being made. Whether you buy the stock or not, watching Sandisk is like watching the speedometer of the AI rollout. If Sandisk slows down, it means the infrastructure build-out is slowing down.
That's a great way to put it. It's a bellwether.
Absolutely.
Before we wrap up, I want to leave you with a thought. We talked about the cycle. We talked about how chips always boom and bust. But here's something to chew on.
Let's hear it.
We know the history. But AI isn't just another gadget like a smartphone or a PC. It's fundamentally rewriting how we process data. So ask yourself, are we actually in a period where the demand is so insatiable that the old rules of supply gluts just don't apply for the next 5 years? Or is supercycle just the comforting lie investors tell themselves right before the bubble bursts to justify paying 80 times earnings?
That is the billion-dollar question. And usually, history wins. But sometimes technology really does change the rules.
And on that note, we'll let you decide. Thanks for diving in with us.
Until next time.